This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City the evening of July 19th. Well, it's no news at this point that the stock market had a very bad day on Monday, with the Dow Jones Index and the S&P 500 down about 2%. This is attributed by the usual chorus of voices in the financial press to the spread of the Delta variant of COVID-19. That doesn't make sense to me, simply because the 3-day average of new cases in the U.S. is less than 25,000, which is less than a tenth of the peak of 300,000. Might be a problem in the U.K. or some other more affected countries, but not in the United States. The problem is inflation and inflation's product, which is stagflation or recession. Now, I'd like to show you again a chart that I showed you on June 19th, which shows the difference between the number of businesses reporting that they have to pay more for inputs and the number of businesses reporting that they're able to charge more for inputs. And as you can see, the gap between these two measures is at an all-time record. In other words, higher costs from energy to lumber to labor to transportation to semiconductors across the board are crushing profit margins of American businesses. This, by the way, is the best recession indicator I've ever seen. It predicted most of the major recessions of the post-war period. In fact, all the major recessions, including 1974, 1979, and, of course, 2008. It may or may not be predicting a recession now, but what it tells you is that things can't continue the way they are. Now, this is also crushing the incomes of households. Household real earnings have been going down steadily for the last 6 months, and that's probably why we had very disappointing retail sales numbers in May and June. Retail sales in real terms were down despite the massive amount of stimulus thrown at the U.S. economy. Does this mean a recession? Well, not necessarily. It could mean stagflation with steady, miserable price increases of about 5 or 6% a year and extremely low growth. Now, the S&P 500 is trading at 30 times earnings. That's price to perfection. We haven't seen that kind of bubble in stock prices since 1999, when, of course, we had several years of negative returns afterwards. Wall Street has been anticipating very substantial profit increases, but if this squeeze on profit margins, this scissors opening between what businesses have to pay and what they can get paid, that's going to be pretty miserable for profits, and analysts' very optimistic forecasts are going to come in low. And the same thing for consumers. As inflation eats into real earnings, they will save more to preserve wealth instead of spending. So the U.S. economy, on the heels of an irresponsible, massive amount of deficit spending, running up against supply constraints, is in trouble. So be afraid, be very afraid. This is David Goldman speaking to you from New York on July 19th.